Greetings, and welcome to the Brooge Energy Limited Half-Year 2021 Earnings Results Call. At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. As a reminder, this conference is being recorded. I'll now turn the conference over to your host, Mr. Walter Pinto, Managing Director of KCSA Strategic Communications. Thank you. You may begin.
Thank you, operator, and good morning. Welcome to the Brooge Energy Financial Results Conference Call for the 6 months ended June 30th, 2021. On today's call will be Nico Partingcooper, Chief Executive Officer, Saeed Masood, Chief Financial Officer, and Lena Saib, Chief Strategy Officer. We'd like to remind everyone that this conference call contains certain forward-looking statements. All statements that address our operating performance, events, or developments that we expect or anticipate occurring in the future are forward-looking statements. These forward-looking statements are based on management's beliefs and assumptions and are not on the information currently available to our management team. Our management team believes these forward-looking statements are reasonable as and when made. However, you should not place undue reliance on any such forward-looking statements because such statements speak only as of the date when made. We do not undertake any obligation to publicly update or revise any forward-looking statements, either as a result of new information, future events, or otherwise, except as required by law. In addition, forward-looking statements are subject to certain risks and uncertainties that could cause actual results, events, and developments to differ materially from our historical experiences or our present expectations or projections. These risks and uncertainties include, but are not limited to, those described in our risk factors and elsewhere in our annual report on Form 20-F filed with the Securities and Exchange Commission, and those described from time to time in other reports when we file with the SEC. And now let's turn the call over to Mr. Nico Partingcooper, Chief Executive Officer of Brooge Energy. Nico, please go ahead.
Very many thanks, Walter, for the introduction, and thank you everyone who has joined us on today's call. As you know, there continues to be significant volatility across the world, with particularly disruption to global supply chains. Our storage terminal provides a crucial service at this time, acting as an essential link in the oil industry value chain by supporting the infrastructure and storage needs of the industry and enabling the markets to work efficiently. Oil storage continues to be in especially high demand, and as our terminals are in an ideal geographical location, it has been incredibly important that we demonstrate reliable service at this time. I'm pleased that we have achieved this with our Phase 1 terminals continuing to operate seamlessly and at full capacity despite disruptive market conditions. This reliable and high-quality service has been recognized by the market, with BPJIC winning the Global Forum Award for the Best Terminals of the Year in the Middle East for the 3rd time in a row. Moreover, so far this year, we have been able to take advantage of the high demand for oil storage and our growing reputation as one of the best providers in the industry by securing new contracts with more attractive terms. In June, we renewed fixed lease contracts with our clients for 233,072 cubic meters of Phase 1 storage capacity at a premium that is 70% higher than the starting fixed lease storage price of the earlier contracts. The contract renewals consist of a total of 190,072 cubic meters signed with 2 clients on a 3-year terms, each consisting of 1 year plus a 2-year mutual renewal clause. The remaining 43,000 cubic meters was renewed by a client for a 3-year term consisting of 6 months plus 6 months, subject to a mutual return for an additional 2 years. These developments follow the 5 new customers that we secured in 2020 at higher fixed storage rates and terms of agreement. This further demonstrates the resilience of demand for oil storage during this time of macroeconomic uncertainty. We are pleased to have delivered year-over-year growth in revenue as our business benefited from higher fixed storage rates. Revenue for the 6-month period ended June 30th, 2021, increased to $23.3 million as compared to $22.9 million for the same period ending June 30th, 2020, with a greater portion coming from fixed storage revenues as opposed to variable ancillary revenues. We have also commenced operations at our Phase 2 storage facility and have received our first cargo at the terminals, following the successful completion of all testing and commissioning at the site and the receipt of regulatory approvals. This is a major milestone for Brooge Energy and follows months of careful planning, construction, contract negotiations and testing, all while navigating a challenging macro environment, which impacted on our supply chain and construction timelines. The Phase 2 facility, which now includes capacity to store crude oil along with fuel oil, is officially open and will be contributing revenues in the second half of 2021, with the entire capacity fully contracted within multi-year take-or-pay contract. Our Phase 2 facility was built to the same award-winning standards as our Phase 1 facility, utilizing some of the latest technology to maximize company performance and efficiency while reducing operating costs. Our seamless automated storage solutions use a superior facility design that is designed to reduce product losses for the end users and offer ancillary service solutions such as heating and blending. The facility includes clean petroleum product storage capacity as well as crude oil storage capacity and is fully contracted. Following the launch, BPJC is now the second largest independent storage operator in the region with a capacity of approximately 1 billion cubic meters or 6.3 million barrels. Simultaneously, we laid the groundwork for our Phase 3 storage facility and refinery project. EY completed the feasibility study for Phase 3, the result of which support the financial viability of the project. EY highlighted upcoming infrastructure investments in the region as a key driver for sustainable storage demand and rising domestic and export demand for refined products as a key driver of the refinery demand. We are very encouraged by these results. The Phase 3 expansion project is for a 2.5 million cubic meter storage oil facility, a modular 25,000 barrel a day refinery, and a larger 180,000 barrel a day conventional refinery. The successful build out of our Phase 3 facility would position the company as the largest independent oil storage facility in Fujairah, with capacity to store clean petroleum products, middle distillates, high and low sulfur fuel oil, as well as crude. The Phase 3 expected construction period is 2 years. The feasibility study indicates that the project has robust economics and reinforces the strength of our business strategy, highlighting that the oil market is expected to continue to be the most important energy source going forward, with the Middle East region continuing to be the leading producer and exporter of crude over the medium to long term. Our strategic positioning in Fujairah, where there is a high utilization of third-party storage terminals, along with upcoming infrastructure investments, is expected to drive sustainable and growing demand for our storage solutions. To leverage this opportunity as much as possible, we also plan to build out a modular and a conventional refinery, including the capability to comply with the new IMO 2020 low sulfur rule, at a time when the UAE is adding to its oil production capacity, which we anticipate will drive demand for refinery services for both the domestic and export market. We have signed a refinery agreement with an oil trading company for the 25,000 barrel a day modular refinery. We plan to sublease the land to the oil trading company, which will be responsible for constructing the refinery, including bearing the full cost of the construction. When the construction is complete, we will be responsible for operating the refinery, earning revenue from tolling fees on a take-or-pay basis. The agreement between BPJC and the oil trading company includes a tolling contract for a tenure of 20 years, 20, consisting of a 5-year contract to commence upon completion of the construction of the refinery and 3 renewal periods of 5 years each. With the UAE adding to its oil production capacity, which we anticipate will drive demand for refining services for both the domestic and export market, We believe this is an opportune time to enter this segment of our industry. This agreement is a low-risk approach to advancing these plans as a toll trading partner, will own the assets and take on the cost of construction and any oil price risk, while our focus remains in our area of expertise as the operator of the facility. This is expected to drive additional revenues to Brooge Energy at favorable EBITDA margins. We are now looking forward to potentially starting construction for phase 3 over the next several months. Meanwhile, we are also in discussions with top global oil majors which have expressed interest in securing portions of the capacity of our phase 3 storage facility. Prior to beginning construction, we will ensure that the capacity is fully contracted on a multi-year take-or-pay contract to provide revenue stability and visibility. With that, I will now turn over to Mr. Saeed Massoud, our CFO, to talk to our financial results. Saeed, the floor is yours.
Thank you, Nico. Thank you, Nico, and welcome everyone. Revenue for the 6-month period June 30, 2021 was $23.3 million, up from $22.9 million in the same period of the prior year, due to higher storage rates. In 2020, higher storage demand was triggered, especially after the WTI crash, and a global shortage of storage was highlighted more specifically in Fujairah, which drove the storage fees higher and the demand for ancillary services lower. In addition, the company's high-tech and high-speed facilities with the lowest product loss ratios attracted increasingly more attention, enabling the business to obtain 5 new customers with high premiums. The decrease of $4.1 million in ancillary services as compared to the same period of the prior year was offset by $4.5 million from new contracts at higher storage rates and terms of agreement. Ancillary services revenue also includes port charges of $1.3 million that are paid by the company to the port authorities and recharged to the customers. Direct costs increased by $1.1 million or 17.2% to $7.2 million in the first 6 months of this year. The largest expense increase was $0.6 million in port expenses due to the increased port activity and movement with the introduction of more customers. Next was an increase of $0.2 million in inventory in preparation for the operating of phase 2 operations. The remaining $250,000 reflects high insurance charges, maintenance charges for the port equipment, and higher depreciation for normal increases in office fixed assets. Gross profit for the first 6-month period was $16.1 million, compared with $16.7 million in the same period of the prior year, representing a year-over-year increase of 4.0%. This decrease of $0.6 million in gross profit is a result of an increase in direct costs by $1.1 million, partially offset by increase in revenue by $0.4 million, as I just mentioned. General and administrative expenses increased by $1 million or 38.9% to $3.7 million in June 2021. The major reasons for the increases are an increase of $0.66 million in professional charges, which includes legal, consultancy, and research charges, as well as professional audit fees of $0.06 million due to the audit of BEL and BPGIC for the half year and year end. An increase of $0.39 million in salaries and wages, which is due to the new equipment starting from April 2020. An increase in insurance charges of $0.2 million, which includes insurance for executive level employees and directors, as well as an additional increase of $0.04 million in board members' fees. These increases were partially offset by repairs and maintenance costs, which decreased during the first 6 months of 2021 by $0.09 million. Due to restrictions associated with the COVID-19 pandemic, traveling expenses decreased by $0.062 million, advertisement expenses decreased by $0.057 million, and business promotion expenses decreased by another $0.087 million. During the first half of the year, finance costs increased 64.8% year over year to $5.6 million from $3.4 million. The main reasons for the increase in finance costs are the finance cost on borrowings and bank charges includes interest expense of $4.8 million on the $200 million bond financing facility, as compared to $2.3 million in interest expense for the 6-month period ended June 30, 2020 on term loans which were settled in November 2020 with the proceeds from the new bonds. Adjusted EBITDA was $15.3 million or 65.7% of revenues in the first 6 months compared with $17 million or 73.9% of revenue for the same period of the prior year. This represented a decline of $1.6 million or 10%. The main reasons for the adjusted EBITDA decline are as follows. Number one, there was an increase in total direct costs of $1.1 million as previously discussed. Number two, also general and administrative expenses increased by 39% or $1 million to $3.7 million. And lastly, this overall increase in revenue by $0.3 million and increase in expenses by $2.1 million contributed to the decrease in adjusted EBITDA. Net profit was $11.1 million in first half 2021 compared to $16.2 million in the same period in 2020. The decrease was primarily due to the higher finance costs and a lower non-cash benefit from changes in fair value of derivative warrant liability. Our balance sheet remains solid with cash and bank balances of $37.2 million at June 30, 2021. Capital expenditures through June amounted to $14.7 million, with the majority of the funds utilized for phase 2 construction. Specifically, these payments were $11.5 million, of which $1.1 million was provided from the company's operating cash flow, and the balance of $10.4 million from the proceeds of the 2020 bond financing facility. Capital expenditures in the remainder of 2021 are expected to be approximately $14.1 million, which is expected to be funded primarily through cash from operations and from the remainder of the proceeds from the 2020 bond financing facility. These planned capital expenditures will consist primarily of expenditures related to the construction of the phase 2 facility. With that, I will now turn the call over to operator to open the lines for Q&A.
Thank you. At this time, we'll be conducting a question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you'd like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Once again, it's star 1 to ask a question at this time. We'll pause a moment to allow for questions. Thank you. Our first question comes from the line of Marta Zudichowska with Edison Investment Research. Please proceed with your question.
Hello. Congratulations on reaching the milestone and launching phase 2. So the first cargo was announced in first half of September. And will phase 2 be operating at full capacity soon, or does it need a ramp-up period, and how long that will take?
Well, thank you for your question, Nico Paharikoper here. The ramp-up period is, first of all, the facility is fully contracted, and as you correctly mentioned, we have started the operations. Obviously, you cannot bring all the 600,000 cubic in one go, and based on today's information, we anticipate this to be completed between 4 and 6 weeks.
Thank you. And just to follow up on phase 2, we know the contracts for phase 2 were already secured in advance. Is there any possibility to renegotiate the contracts to get more favorable conditions based on the high demand on storage?
Yes, I think that you need to see the next announcement of the company in the next few days or week, and then your answer is being given on that part. At this moment in time, we did not announce that as yet.
Thank you very much.
You're most welcome, and thank you for your questions.
Thank you. Ladies and gentlemen, as a reminder, if you'd like to join the question queue, please press star one on your telephone keypad. Our next question comes from the line of Elvira Scotto with RBC Capital Markets. Please proceed with your question.
Hi, everyone. Just a couple of questions for me. Quickly, on the costs, the cost increases that you outlined in the press release and that you talked about on the call, I mean, are those all recurring costs? So should we think of this as the new cost run rate?
Thank you, Elvira.
Yeah, thank you,
Good
Elvira.
morning to you. Saeed, can you please take this question?
Yeah. Thank you, Elvira. So these costs, basically, so this is the full year's cost now for the 6 months, and these are the run rate costs. This will not be going out of in the terms of percentage. This will not be increasing more than what it is now. These are the maximum costs that we have already incurred.
Okay, great. Thank you. And then where are you on the progress now of contracting phase 3? I think you said you were in discussions with some potential customers, but just curious how far along you are. And do you need to contract the entire 2.5 million cubic meters in order to proceed with construction of phase 3?
Thank you, Elvira. So we haven't announced any of the contracts as yet. The team and myself, we are very close to closing partially of the contract capacity. Obviously, we only built, as we always did in phase 1 and phase 2, only built and construct what we have contracted. We're not building on speculations. The capacity is obviously large, 2.5 million cubic, whereby we believe that we can announce, let's say, before we start in the construction, or what type of capacity amount we have been contracted. Does that answer your question, Elvira?
Yeah, that answers my question. And then also on the phase 3 refinery, is the 180,000 barrels a day, is that the expectation for the refinery, or is that just the maximum size depending on contracting?
The maximum size of the plot of land is what we mentioned in the announcement just now, is 2.5 million cubic storage capacity, a 25,000 barrel low sulfur refinery, and a 180,000 barrel refinery. The 180,000 barrel refinery on plot 3 land is the maximum what we can add, with having the other 2 in place, being the low sulfur refinery and the 2.5 million storage capacity.
Okay, great. Thank you very much.
Thank you, Elvira, for your questions.
Thank you. Once again, ladies and gentlemen, it's star one to ask a question. Thank you. Our next question comes from the line of Gus Chayeb with Sancta Capital. Please proceed with your question.
Yes. Hello, Nico. Saeed, nice to be in touch with you again, and congrats, guys, for getting phase 2 launched. That's wonderful. I have just a couple of questions for you. One is, can we expect the gross margins on phase 2? I mean, once after the ramp-up phase, do you expect them to be at the similar levels to phase 1, or higher or lower? That's the first question. And secondly, do you expect any increase in your G&A costs for phase 2? Do you think you need more manpower at the headquarters level and overall G&A for phase 2, or should it be expected to stay around the same levels it is now?
Good afternoon, Gus. Thank you so much for your question. Let me take the second question from you first, and I'll turn it over for the first question to Saeed. So the number of manpower in the facility, as you know, There are 7 people operating the asset. For the 1 million, we don't foresee a significant increase of manpower due to the automation. The asset is managed from control room with a DCS, whereby additional manpower operating that asset is not envisaged to be, if it is a significant number for the operations at large. Said, can you please take the first question from Gus?
Yeah, sure, Nico. Hi, Gus. So we expect the gross margins to improve, obviously, by phase 2 revenues kicking in. Since we have been making almost all the expenses on the maximum size as of the June 30th results from the phase 1 revenues. So we expect the margins to be improved. And as Nico said, that for the SS in terms of direct costs, that might be very slightly, it might increase because of the automation of terminal. It will not be a significant increase.
Wonderful. Thank you both.
Thank you, Gus, for your questions.
Thank you. Our next question is a follow-up from the line of Marta Sudichowska with Edison Investment Research. Please proceed with your question.
I've got a question on phase 3. So we know the total land capacity for phase 3 site is 3.5 million cubic meter, but the feasibility study was based on 2.5 million. So is there any scope to extend the storage capacity in the future?
Thank you, Marta. So the land can house 3.5 million cubic storage capacity overall if the land is fully being built with tanks. Because we are adding a refinery of up to 180,000 barrel, that means a significant size, roughly about 1 million cubic storage capacity. Therefore, the land, as we have mentioned in the discussion or in our call today, that we can build 2.5 million cubic storage capacity, a 25,000 barrel a day low sulfur refinery, and 180,000 barrels a day conventional refinery on that plot of land. So in case the refinery would not materialize, then the land can be constructed with 3.5 million storage cubic capacity and the low sulfur refinery.
Okay, thank you. So in the light of this different capacity, how is that reflected in a potential capital expenditures for phase 3? So the previously guidance for the presentation available from 1 year ago, it was $1.1 billion. So how we should think about it?
Marta, the study that the numbers that we produced in our previous IP, they were indeed $1.1 billion US estimated cost from management side, based on the 3.5 million storage capacity. The EY study revealed that the 2.5 million cubic storage capacity pro rata was not far off what the management has already forecasted back in 2020.
Okay, thank you.
Does that answer your question, Marta, or do I need to elaborate more?
I'll add a follow-up on this CapEx. So how we should think about the timing of the capital expenditures? Should we expect some for 2021 and split evenly between 2022 and 2023, or
the project obviously is a project what is lasting around 24 months to complete the 2.5 million storage capacity if we will build it in one go. So pro rata, the construction obviously is going as per the project schedule and the project costs and the project financing arrangements. Or if we would embark on such a route. So the costs will be prorated over the over the upcoming 24 months from the moment that we start constructing.
Thank you very much. Mm-hmm.
Thank you, Marta.
Thank you. Ladies and gentlemen, this concludes our question and answer session. I'll turn the floor back to Mr. Pardon Cooper for any final comments.
Thank you to everyone who joined today's call. This is an exciting time in our development. We are poised to generate significant growth going forward with phase 2 construction now complete and the facility operational. In parallel, we are progressing with our plans for phase 3 facility, which will include crude oil capabilities as well as adding more capacity for fuel oil and clean products, and are encouraged by the feasibility study completed by E&Y. I look forward to providing you with further updates on our progress on future earnings calls. I will now ask the operator to close the lines. Operator, kindly close the lines.
Thank you. This concludes today's conference. You may disconnect your lines at this time. Thank you for your participation.